Welcome to Talk Tickers. Today we're digging into Eastern Bankshares Q4 2025 earnings, and this one was a real head-scratcher. On the surface, the company put up some strong numbers, but the stock just got hammered. So what exactly went wrong? Let's break it down.
And yeah, that right there is the central puzzle we're going to solve today. The company reported a solid beat on operating earnings per share. I mean, that's the kind of headline that should send a stock higher, right? But that is not what happened here. So what did the market see that the rest of us missed?
Okay, so first up, let's just look at the raw top-line numbers and the immediate reaction on the tape. This is where the whole story begins, really, with this classic beat-and-fade scenario that tells you a lot about the market's real feelings. Here it is. This is the number that got everyone's attention at first, 44 cents. That was the reported operating earnings per share for the quarter. And you know, looking at that number in a vacuum, it looks like a clear, undeniable win for the company.
But here's where things get interesting, right? You got to look at the details. You can see that operating EPS came in almost 7% above what analysts were expecting. That's a solid beat. But then, look at revenue. A slight miss. Just about $1.5 million shy. It's not a huge miss, but it was like a small crack in the armor that made investors stop and say, wait a second, let's look a little deeper here.
And this chart, wow, it shows you the consequence perfectly. The stock spiked in the pre-market on that EPS headline, right? It shot up to over $22 a share, but as soon as the market had a minute to digest the whole report, it gave all of those gains back, and then some. It ended up closing near $20. That is a huge fade and an unmistakable signal of doubt from Wall Street.
So to really get what that doubt is all about, we have to deconstruct the quarter. Let's peel back the layers and get into the core operational numbers. This is where we're going to see what's really going on with the bank's health.
Okay, now the bull case for Eastern is laid out right here on this slide. Their net interest income, which is, the core profit engine for any bank, was up a massive 43% compared to last year. Their net interest margin, or NIM, expanded nicely. Deposits were stable, which is great to see, and their CET1 capital ratio, basically a key report card for financial strength, was super healthy at 13.2%. I mean, these are really strong numbers, no doubt about it.
So, the underlying numbers look pretty good. What was management's big message on the earnings call? Well, it was a very, very clear and decisive pivot in their whole strategy. The message was loud and clear. They are done with M&A, at least for now.
And listen to this. You really can't get much more direct than this quote from the executive chair, Bob Rivers. "We will not pursue any acquisitions. Completely focused on organic growth and returning capital." So the key takeaway here is that this isn't just a temporary timeout. It's a fundamental change in how they plan to use their money.
And here's what that new plan actually looks like. They're going to take all that extra capital they have, which is a lot, and use it for aggressive share buybacks. They've already started, too, buying back over $55 million worth of their own stock just in Q4. The end goal is to bring that super strong 13.2% CET1 ratio down toward 12%, which is still really healthy, but frankly, just a more efficient use of capital from a shareholder's perspective.
Okay, so let's tie this all together and get back to that initial puzzle. The stock fade. We've got good operating results, we've got a new, very shareholder-friendly capital plan, so why the skepticism? Well, this brings us right to the heart of the debate.
This frames the entire debate perfectly. On one side, you have management's pitch. They're saying, hey, look, our core earnings power is structurally better because of the smart moves we've made. But on the other side, the market is asking a really critical question. Is this improvement in your profits, is it sustainable? Or is it just a temporary boost you're getting from the current interest rate environment that's going to disappear when rates change? The stock's price action tells you the market just isn't convinced yet.
So where does that leave us? Let's switch gears and get to our forward-looking analysis. Here's what we at Talk Tickers think investors really need to be watching for on the next earnings call.
So here's our call, step by step. First, for next quarter, we expect the numbers to show that this margin expansion story is going to take time to play out. It'll be a slow ramp, which might test some people's patience. Second, because of that, the stock is probably going to trade sideways for a while. It's kind of stuck until management can deliver another quarter or two of cold, hard proof, which leads to our rating. This is a classic show-me story. The market has heard the talk, now it needs to see the results.
And all of that leads us to our official rating, market perform. Look, the bull case around their earnings power and the new capital return plan is compelling, but that's pretty evenly balanced by the market's very valid skepticism about whether this profit lift is going to last. To us, the risk and the reward feel pretty evenly matched right now.
And for our trade idea today, with all this uncertainty swirling around, The stock's options are actually more expensive than usual. So one strategy to consider is selling volatility by selling cash-secured puts. Now, in simple terms, that just means you get paid some cash today for agreeing to buy the stock at a lower price down the road. The whole bet is that the company's huge share buyback program is going to act like a safety net, keeping the stock from falling too much further. It's a way to generate some income while you wait for this show-me story to unfold.
And as always, this is not financial advice.